Portfolio Builder members, welcome to our Thursday webinar class. And just a little shout out to Jerry. I think you're probably wishing you hadn't wrote the covered call on your VIX position this week, huh? And so we'll go over what's going on in our portfolio. Crazy rally after we put out our defensive trade alert today. Trump came out with a tweet saying he has an excellent alternative to a trade deal and that they could still make a deal today. They're having dinner tonight. Our plan is to play it safe and then ride the increase in volatility through selling call options. So start off by taking a look at today's trade alert, how the prices have changed today just since we put it out, and then we'll open it up for Q&A. So first we sold our FAS and TECS for a large profit, so that was well timed. If you did get out of that, we had a small profit. It helped protect some of the downside. We closed that 287.50 covered call for a large profit. If you missed that, then those prices have certainly changed in the last few hours. We'll discuss what to do about that. Step 3 was to sell to open the 275 May 10th, 2019 covered call. We're looking for about $10 of protection between now and tomorrow morning. So that was the goal of that trade. And again, the prices have all been shifting around. So I'll look at what I would do right now if you have missed a trade thus far. And step 4 was to switch out our 5% inverse hedge and go for something a little more advanced. I rarely will buy a long option because typically long options just lose value very rapidly. But this is a situation where things could get spiral out of control. So this is a time where a 1% portfolio position in the leveraged 264 long put option made a lot of sense today. And we'll talk about why we chose that 264 strike and how we will react to the market. This was a $40 baked into the cake profit if we were wrong. Do want to point out that this was a very unexpected move in the market. Last week we were sitting on all-time high Friday at the close. Trade deal was baked into the cake, priced into the market. Everything was looking like it would wrap up. And then we get the Trump tweet Saturday morning. And so the market has continued to bet up despite this threat. And so while the S&P 500 is down, when I took the screenshot, 4%, our portfolio had only lost 1%. So people are losing money at 3 times the rate as our program if they own the SPY. Now, if you are owning specific equities, quite likely you're sitting on much larger losses than that. So we're reacting to the market movements gradually. You can see that I have been hesitant to get over defensive because the market is leveraged to go up in the long run. So it's very risky to bet down. And part of our strategy with the in the money covered calls allows us to have a relatively risk-free way to bet on a sideways or down move in the market. So we finally have capitulated and gone into full-blown defensive mode between now and Friday. So that's just a short window of time. We have less than 3 hours before the market closes today to worry about. We have the futures market overnight, and then we'll be ready to cover this position and make a decision on how much protection we want between now and Monday. Most likely a very similar defensive position between now and Monday, unless we have some amazing resolution overnight, which while I do think a trade deal is 80% likely to occur, the timing is what we're worried about right now. Okay, moving lower, we'll just go through today's trade alert. Rarely do I issue emergency alerts, but with the market pulling back, actually what's been most alarming is how much the Chinese market has been crashing. They've been crashing at a rate of 3 times that of the S&P 500. So the pain that we're seeing in the American stocks is 1/3 that of the crash that's happening in the Shanghai composite right now. And so that is an alarming crash, and one reason I decided to play it safe. We've been rather neutral this week, and we've now moved into the defensive position. So let's take a look at where this is trading at right now. Now this is actually really good news. If you did miss the trade, you can still cover it. Instead of having a $2.20 profit on the covered call, you only have about $1.50. But look at the change in price of the SPY. When we covered it, we were at 283. When you're covering it now, you have an extra $300 of profit per contract. So if you were for some reason late to the game, still a good time to cover that position and pick up a much larger profit. So that's good news for you if you were a little late to that trade alert. The next, and this is again 1 contract per 100 shares of the SPY. And so that trade did very well in protecting our assets. And if you did delay a little bit on the reaction time, you're doing even better than our model portfolio. All right, now looking at the second trade. Pulling that open 1 second. The second trade is a defensive play. So we want to add protection to our underlying asset and generate a profit if we're wrong. So we're betting with a in-the-money covered call that the SPY is going to trade flat or down. And so at the time of putting on this trade, if we look at the trading prices, I was able to collect $9.23. The target credit we want today is between $9 and $10. That's the amount of protection I think will more than cover any potential drawdowns between now and Friday, especially when we look at the final piece of how we're playing this with the long put option. So if you were taking this trade right now, you could certainly move this up a few strikes and to the 277 and get that target credit of protection. So let's just look at the trade I put on and how it plays out. So you can see I agreed to sell to open the May 10th, 2019 275 strike, which means I'm agreeing to sell my 100 shares of the SPY to a stock speculator for $275. And what's curious about that is $8.83 below the current trading price. So why would we do that? Because they're going to pay us $9.23. And so we have a baked into the cake profit of $40 per contract if we're wrong. And currently we are wrong. The market's going back up. Our fear potentially was wrong today, and the market's coming back up because of that tweet. Now, here's been the trend all week. During market hours, Trump has come out saying, hey, don't worry, we're going to make this all work out. And then right at the close, right before the Asian markets open up several hours later, they're coming out and trying to scare that the trade deal will not happen and that tariffs are guaranteed to pop up at midnight tonight. And so the effect of that has been that the Chinese market is getting hit much harder than the American market. So they're able to reduce the losses in the American market during the daytime with these positive tweets and then really destroy the Chinese market. And so the Shanghai composite is a good one to watch, but this is just a American ETF we can take a look at so we can see the kind of pullback FXI has had during this series of tweets. And so they're sitting on about a 10% loss. Meanwhile, the SPY is sitting on about a third of that. So far it looks like the negotiations are working in our favor, and a few more days of precaution makes a lot of sense. Now, if we go look at the option market, before this big rally, we can see that most of the money was on the put option side, but it was above the trading price, which means that investors are willing to purchase SPY's shares as the price increases, but they get it at a discount. So it's quite a deal for people making this trade today, that they would agree to buy the SPY up at this 285, 286 level for a $3 to $4 discount. So that paid off very well for the folks writing those options, and as well as anybody buying these call options today. But will it last? That's definitely questionable. The 5% hedge, sure, we wish we had a little bit more on that. But if we had come to terms early and the market had rallied very quickly, this 5% position could have lost 1 to 2% of our total gains this year in a heartbeat. So I was very skeptical to load up too heavy on this hedge. We had a 5% position, and we're able to sell these for a considerable profit in a very short period of time. So we put this position on Monday and now sold it today, and perhaps hit the high of the volatility with those positions. So we perhaps got about the all-time high this week for both of these two tickers. And again, it wasn't a huge position. Now, it's not that we don't want to hedge. We are substituting it with what I would call more of a sniper shot. So while the inverse ETFs are very easy to sit on and just buy and sell as you need, this long call option is much riskier, and it is aiming at a very far out target, which is why I call it the sniper position. You know, maybe think of this as your machine gun in war. This is your sniper. And so when we're doing a sniper trade, we're going to go much smaller. Our total risk on this trade is just over 1% of our portfolio. So 264 is the strike price where CTAs will go to full-blown selling mode, and without some sort of intervention from larger forces, we could see a serious collapse if the SPY were to reach that level. And this is analysis that's done by a guy named Charlie McElligott of Nomura. So I'll post some links tomorrow to learn more about this guy. He actually has a podcast coming out from Macro Voices on YouTube tonight, which is always an interesting listen. So this position is currently, when we bought it, costing $369 a contract, and that's relative to owning 100 shares of the SPY. So not only do we have $10 of protection on the SPY between now and Friday morning, not only can we make a profit if we're wrong and the market does go up on the SPY trade, we also have this protection into July 19 of this summer, where if the market does start to crater, this little 1% position could add several percentage points to our total return just by holding on to this for probably the next, I would estimate, 4 weeks. So it's a very leveraged play, and currently it is down. Let's see what you could purchase this for right now. So you could purchase this for $282 right now and have an even better price on this long option. Now, what I'd like to do next is take a look at our portfolio. The true return on our portfolio will be a lot less than this, probably closer to 6% come tomorrow, because we have a lot of profit on this covered call today. That will be less once we cover it, depending on where the SPY trades from today. So that's how we've inputted that trade. Covered call generated a substantial profit of a 74% return, and we've inputted the rare long option purchase right here. And again, 1 contract per 100 shares of the SPY makes a lot of sense. If we do get a major sell-off, this could quickly go towards the $10 to $15 price range, which will add up a lot of profit in our portfolio on top of doing these boring, repetitive, in-the-money covered calls. So that's a look at how our basic portfolio is reacting to this market. Now our diamond program is doing incredibly well. Because it only trades on Tuesdays, we had to play it much safer. And this program really does not want to touch the portfolio more than once a week. Now, I did not add the long option on this portfolio today because it has so much protection already in the program from these in the money covered calls. So unless we get closer to 115 on Microsoft, 180 on Apple, these stocks are just really performing well during this market downturn and outperforming the S&P 500. And again, there's no magic as to how we pick these companies. This is where the SPY ETF invests your funds. So if you look at where the SPY and QQQ, the two highest traded ETFs in the world, they automatically flow the capital straight into these companies. Not only that, these companies are now getting ready for corporate buybacks, and they have the most profit out there to do so, as well as the best credit rating for borrowing cash. So these companies are very protected and insulated from minor volatility in the market. So beyond that, we have these in the money covered calls, which we will most likely cover Tuesday. Now, where the strike will be on these, we'll have to see what happens between now and Tuesday with the trade war. So this one, again, does not have any kind of long hedge. It is completely protected and bulletproof at this point and continues to crank in very nice profits. Now, this portfolio does cost about $150K to build to have the same allocation per company, but the breakdown is you end up with 300 per 150K. Now, if you do use one-to-one leverage, that's completely fine with this strategy. So you could follow it with 75K at almost all brokers. But 300 shares at Microsoft, 100 at Apple, Facebook, Intel, Cisco, 200 at Comcast, 900 Bank of America, 500 Wells Fargo. What you'll notice is we did pull out the Amazon, the Google, and the Berkshire. Those shares would cost far too much for our average client to have 100 shares. And you get that exposure with the SPY. So if you have more than 150K, overflow it into the SPY so you have a more diversified portfolio. And yeah, so this is performing at twice the return with 1/3 of the work as our basic program. So that is doing very well. No changes in this portfolio for those of you who are in the Diamond program. All right. And for those of you who are in our cryptocurrency program, where Google made an update that we have to reflect in our app software. And this portfolio is just skyrocketing. This was last updated when Bitcoin was only at 5,200. Now it's at 6,000. So this one's probably over a 50% return this year and is also included in our Diamond program. So if you want a small exposure to cryptocurrencies, that is included in our Diamond program. And we have quite likely the best product out there for cryptocurrencies. The goal of the cryptocurrencies is to build an ETF-like portfolio that's very similar to the SPY, and it's based on the trading volume of each of these cryptocurrencies. So I do hope to have that software update out in the next, hopefully by Monday. Now, this is a buy and hold portfolio where we would never put more than 5% of our total assets to buy and hold these. So that's a good wrap up of what's going on in the portfolio. Let's take a look again at the current price on the SPY. And what I want to do really fast is just a review of what the in the money covered call is and why it's such a powerful tool in market conditions like this. Now, normally our goal is to, so for the past year, we've been dealing with very low volatility, or for the past 5 months, that is. We've been dealing with decaying market volatility, and that's absolutely terrible for someone who wants to sell call options to speculators. And so while this downturn sure makes you feel a little wobbly in the knees, it's important to note that we barely lost any capital. And now the option premium is at 4 times the rate that we were earning just a week ago. So this is great news. I suspect this volatility will top out by next week, and we'll be able to enjoy the higher premiums for probably about a month. Now, if I'm wrong and the market crash continues, we don't get some sort of truce or at least a delay in trade war, then this could certainly go higher, and we're positioned very, very well for that. And so while we're in this high volatility climate, it makes our job of protecting our capital and generating a consistent return really, really easy. And so let's just take a look at some of the examples of how this would play. So here's a real-time trade that potentially could be put on. And what's interesting is that by owning the asset and selling the covered call, it puts us in a very lucrative position to generate profits in all market conditions and end up, in the worst case, in cash. So I want to explain why it's a lot smarter to own the SPY and sell in the money covered calls versus doing the opposite and selling put options. So let's look at two scenarios and compare the differences, because a lot of people wonder, well, should we just be selling the puts deep in the money? And so I'll explain why you don't want to do that and why our strategy is far superior. So here's a situation where we can agree to sell our SPY shares for a strike price of $2.79, which is currently trading at $7.28 below the current trading price. So that's an immediate loss of about $7.20. So why would we do that? Because the stock speculator will pay us $7.70. So that's a $50 profit per contract. And remember, our portfolio in general only wants to make $25 a contract and be able to realize the profits on the underlying asset. So in this situation, we have a $50 profit per contract if we're absolutely wrong and the market jumps higher. Now, what if we're correct and the market goes lower? Well, we are sitting on $7.70 of protection, and there's less than 2 hours left before the market closes and the next morning begins where we could cover it. So it sets us up in a position where if the market goes lower, we have a lot of protection and can cover the position the next morning quickly. If we're wrong, the market flies up higher, they exercise their right to that option contract, we keep the option premium, they purchase the shares, we're back into cash. Let's look at what would happen if we did the opposite of this today. So we could do the opposite and sell a $2.79 put. But what happens if the market were to crater between now and the market opening? Well, we would get assigned into owning this stock overnight and be sitting on a huge loss on the SPY tomorrow. So the difference is if we get exercised while selling a put option, we're going to have to hold that position overnight and end up owning the stock during a condition where the market's most likely crashing. If we do the opposite trade, we put ourselves in a situation where if we're wrong, we're not stuck overnight in owning shares, we're going to end up in cash. So that's why it's a lot smarter to own the SPY and write the in the money covered call because we have the ability to exit at any point in time and not be stuck owning volatile shares during a market crash. So that's just the big difference. One is in the business of loaning stock speculators SPY shares, where the outcome of you being wrong ends up in a cash position, whereas the other is doing the opposite. You're loaning out dollars, and when the market goes against us, we're going to end up having to purchase those shares and deal with it the next morning. And typically, if the outcome was against us, we'd be holding a big loss. So that's why we do this the way we do it. And when we want downside protection, we can use those inverse ETFs, or we can buy the long put option. So we've got quite an audience today. We're up to 23 folks. Let's see what kind of questions we have piling in there. Okay, we've got some questions coming in. Okay, one question was, how's the emerging markets portfolio doing? Let's take a look. This is a bonus with the Diamond program, and this bets on growth in the emerging markets, which is primarily China and its trading partners, which are primarily South Korea, India, Russia, Brazil. So yeah, it's getting hammered. It's only up 1.6, whereas the rest of our portfolios are greatly outperforming. Now, I do think in the next 10 to 20 years, this will be the portfolio that you can sit on, do nothing, and it outperforms. And this is a good investment for a small part of your portfolio, for a little overseas diversity. But it's not as good at generating income like the SPY ETF is, or like our Diamond program is. So clearly China is getting hit at about 3 times the rate as the American markets right now. Okay, we got a question. What do you do in the case that the shares were called away due to options expiration? So yeah, once again, if we do get exercised, then we get the baked into the cake guaranteed profit, which we always have a small profit baked into the cake at the price we write our in the money covered calls. So we sit on that profit and we're in cash. So you wait till Tuesday for the next trade. Very simple. Now, if we're doing the opposite again, you'd be in a totally different situation and have to be a much more active trader. So by writing in the money covered calls, if we're wrong, we end up in a cash position with a guaranteed profit. Let's see, I'm going to unmute a few of our, if you want to be unmuted, let me know with a message. Henry, how are you doing out there?
Good, Jason.
I've unmuted Henry. If anybody else wants to unmute, let me know. Okay, we got a question. Isn't the risk the same in a crash where the covered call scenario is used versus a short put? The market gaps down below 279 strike in your example, the risk is the same in the. So yeah, the difference here is that if we own the SPY and write the covered call, we can buy back our covered call and move our protection even lower. So we can take a profit on the covered call and extend the protection. And that's a very easy thing to do for us. And then with the market jumps back up, we usually have a baked into the cake profit. Now, when we're writing the put option, we don't have that same opportunity. We could buy back the put option for a loss, but again, the difference is in one method we are loaning out shares to speculators. In the other scenario, we're loaning out dollars. And so they definitely have a lot of similarities, but are much different. And so that's exactly what happened today. We bought back our covered call for a profit and rolled it $10 lower. So it's a very simple trade and very easy to do. Any questions from you today, Henry?
Nope, just did my trades this morning. That was it.
Nice. Did you have those? Did you have your Tex and FAS shares hedging?
No, you know what? I like I said, I've been traveling for the last 2 weeks, so I just did my SPY trades, and I missed that part of that trade the other day, so I didn't get that on.
Oh, okay. Well, no worries. The good news here, guys, is the option premium is skyrocketing right now, and that means that our strategy is basically like we own an apartment in New York, and we're using something like the Airbnb app to rent it out for short periods of time. The rent has quadrupled, so this market action is great. It creates much higher option premiums and allows us to to set up these situations where we have a lot of insurance and still generate a profit if the market goes up. So we're up to 23 people in our webinar today. Welcome everybody. Some people are just joining in. If you have any questions, please go ahead and post them in the question box. But yeah, we're in a very nice situation right now. Sure, do I wish we had waited an hour to do our trade? Yeah, of course, we would have had an extra $300 a contract sitting in our portfolio with the 1,700 shares. You know, that's about 8,000 bucks we missed out on today, but we played it safe. We are completely protected. Market's down around 3% and we're only down 1%, and we're set to generate a profit between now and tomorrow. And if things do get nasty, we're completely protected. Okay, Fred says, what is your opinion on initiating both in the money and out of the money simultaneous spread trades? So yeah, the way we designed our platform, and again, a lot of people on the basic product are not going to be using the spreadsheet, which is fine. Not everybody likes spreadsheets. So this product I have, by design, made it so easy. You know, like Monday, I said, all right, you're going to need 50 shares of TEX, 100 shares of FAS, 100 shares of SPY, 1 covered call. So it's easy to do it in your head. Today, I said, sell your TEC, sell your FAS, per 100 shares of the SPY, grab 1 QQ, or rather, to make everyone's life easy, instead of doing the put on the QQQ, we just did the SPY at that 264. So really, all you're watching is one ETF, the SPY, the most important security in the world. So it's designed to be very, very simple to do in your head on the fly while you're traveling from your phone. And now we're in a position where it's very hard for us to lose money. If the market drops lower, we're going to do very well. If the market goes up, well, our risk is this 1% position over here, which is already down a few bucks. Let's see what it's down right now. So this cost us $369. Let me so this one is currently down about 90 bucks a share. So if you miss this trade, now you can get in for $90 cheaper. And again, just because the market has gone up today, this has been the trend all week, that the market is getting rallied through the day with positive news. Right when the market closes, they come out with the negative news so they can put pressure on the Chinese market in the Shanghai. And so what I'm carefully observing now is the moves in the Shanghai index, the Hong Kong index, and then the currency rates between, and China has 2 different currencies, an onshore and an offshore. So we're looking for anything to really break down to signal that bigger problems are developing. So as far as our portfolio is going, it's defensive at this point, but it's not an extreme defense. We're really just in a position to survive from now through Monday without any kind of harm if the trade war escalates. So that's kind of where we're set up right now in this moment. Okay, I got a question. For people who missed that trade, should they do it now? Yes, absolutely. Okay, oh, back to you, Fred. Sorry, would you do both? No, I wouldn't do both. And we didn't design our product to do both. As you can see, there's only one line for the SPY. Now, if you wanted to do that, you could go alter this and have, you know, it'd be like a layered approach. So certainly that's not the worst idea in the world. And if you were trading more like 10 to $50 million, you're not going to be able to fill all these covered calls at a single strike. So now all of a sudden, yeah, you really do need to layer your approach. For our members, we don't want to make your life complicated. So we're just doing one strike and one line to make everything very simple. And that's the goal of this. Keep it very simple, protect our assets, generate profits consistently. And then really our major concern is looking out for big downturns in the market, which is not a problem. If there is a downturn in the market, usually the best signal is the start of a rapid sell-off. So we've been waiting all year for this sort of condition to develop. I know you guys have been watching me write these semi-defensive trades all year. We were wishing we'd made all of the gains of the SPY, but we kept playing it safe. Well, finally, we're getting that volatility. Right, Fred. So I understand your question. If you wanted to have different strike prices, you would have and manage it in our spreadsheet, you would just go like this. So if you wanted to play it kind of in two directions, you could go and do something like that. But I wouldn't recommend it. That would be a strategy for someone who's trading something like $10 to $50 million. And the only reason you'd really want to do that is because you couldn't get your position filled because you have so much capital. So that's typically who will start layering their covered calls at various strikes. For us, this is a huge amount of protection with a guaranteed profit. And so our goal is to collect small amounts of profit, around $25 a contract, 3 times a week, 52 weeks a year. That's around a 1% return per month, while still being able to enjoy the increase in value of the SPY. Now, we've been averaging closer to 2% this year, so we're actually outperforming our goal by 2 times. Now, some people might ask, why aren't you buying any call options to profit from upside move? And because we don't need to do that. We can essentially do that same strategy by selling the overpriced call options against our SPY. So the second we see relief in these trade tensions, you're going to see the profits pile in because we're going to write that covered call above the trading price and be able to pull in around $25 to $50 a contract and enjoy the appreciation of the underlying asset. So right now, the time to take risk is not, it's just not a good time to do it. We don't want to buy call options when the VIX is spiked. The time to buy options would be if the VIX was lower. But we don't need to, because by owning the asset, we can sell those call options and really just pull money every Monday, Wednesday, Friday right out of the option market. So we're set to jet. Just need to play it out for a few more days with precaution. And if things escalate, we'll just continue to hold our long put, which will go up and up in value. And we'll continue to write these in the money covered calls. If things de-escalate, we will sell that hedge and start writing a covered call that is either at the money or out of the money. And that will be based on just what comes out of these talks in the next 48 hours. Let's see what other questions we got here. Okay, so I got a question. If starting today, buy 100 shares of the SPY. Yep, so let's go over how you would start out today. And it's all written out in the trade alert, so we try to make this very, very easy to follow. If you're on a free trial, you don't get the spreadsheet, but that's fine. You don't need the spreadsheet. Again, this is very simplistic by design. And sometimes the more simple strategies are much smarter than these more complex ones out there. And so as you can see, we've been able to consistently protect capital and generate profit during all market conditions. We started this in the Christmas massacre, where the market had a historically rough crash and then a historically record-breaking return so far in 2019. And now we're having another crazy crash. So it's This strategy works very well for taking the sting out of the market. We make a little less when the market goes up, but we lose much less when the market goes down. And as we react, we can actually profit from downturn. Now, I don't want to predict downturn before it happens. So when downturn does begin, that's when we might see a tiny loss short term. We're not going to predict something before it happens because betting down almost always loses. So you're seeing how we can react now and profit. So step one is you have to buy 100 shares of the SPY, but you don't want to do that unless you're following the covered calls, because this gives you the protection. The trade alert today said you need to get between $9 and $10 of credit by writing a covered call. So let's see where we would write that right now to get that same level of protection now that we've had this big run up. Okay, there you go. So we did a little bit lower today because market was lower. We did the 275. You can get that same protection right now for 277. So let's look at the economics of this trade right here. The SPY is trading at 286.58, and we're agreeing to sell this for a loss of $9.50. So now you'll notice, because the volatility has dropped since we did that trade alert, where I was able to have a baked into the cake profit of around $40, this one has a baked into the cake profit of $20, which is fine. That is the goal. If we can pull $25 of profit 3 times a week, that generates a 1% return on capital. Now, sometimes we'll get double that. That's what we've averaged so far. But during a situation like this, to get a $10 insurance. Okay, so are there fees for the assignment? Then write a two. Okay, so let's look at the questions. So then write a 290 call. No, do not write a 290 call. Our trade alert was the 275, but what's more important is the amount of option premium you're collecting to protect your asset. So I'm looking for between $9 and $10 of option premium credited to my account to protect that position, because there's a high risk that trade talks break down and that this escalates. So if you do want to get into the market today, probably a great time to do that. Okay, I don't see any of the $20 baked in. Okay, so yeah, let me explain how this is baked in. We're selling a May 10th, that's tomorrow, 277 call option. That means you're agreeing to sell your shares for $277 a share. And that comes in at a loss of $9.54. So why would you agree to a $9.54 loss? Well, the reason why is because the stock speculator is willing to pay you $9.75. So that's 20 cents per share. What's 20 cents times 100 shares per contract? 20 bucks. Now, are there fees for assignment? Yeah, usually it's about 10 bucks unless you use a good broker. So TD Ameritrade, if you negotiate, you can get these down to around $1 or $2. If you go to Robinhood, they pay 100% of your commissions on all aspects, from assignment to stock trades to option writing. So when we're playing the banker and we're trying to pick up guaranteed high probability returns with low risk 3 times a week, sure, we don't want to give up our money to the broker. So if you have an expensive broker, it does make a lot of sense to find a better deal. Now, Henry over here is trading a very large portfolio, larger than our model portfolio, and he has almost free trades because he took the time to call up TD Ameritrade, tell him he's going to move to Interactive Brokers if they don't lower his rates. And so you definitely want to. Okay, so we have a question. Will assignment funds be deposited into the account the same day? Assignment always happens after the market closes, and so it's kind of a round robin deal where we don't know for certain if we will be assigned or not. So if you are assigned, the next morning you'll have a huge cash deposit and be be out of the SPY. So that's one reason I do prefer to own the SPY and write the covered call, because we end up in a situation where we're back to cash. When we write the put option and you're not paying attention and you're wrong, you're going to get assigned and be owning an asset that is in free fall. So quite a large difference. But certainly there are a lot of discount brokers out there, and you can get these costs at least down to $1 or $2 or less. And if you go with Robinhood, they don't support the 401k. Another broker I like is Tradier. So these guys have unlimited options trading for $50 a month if you call them up and negotiate, and they will take your 401k. They also have just cheap prices outright. Interactive Brokers is extremely cheap, been around a long time. There's a lot of great brokers out there, so we're not recommending any certain one. Okay, so DD says, where do I see the trade recommendation? So yeah, for those of you guys having a hard time finding the emails, you may need to go look in your spam box, because you're already getting the content. So you might look in there and find it and mark it as not spam by clicking that. But the trade alert comes straight to your email and text message. So here's a look at today's trade alert in my email box, just to show you what it looks like. So we write it out very clearly. You have a video that overviews it. Typically the video is about 10 minutes long. Again, your text message has that automatically linked, so you get that fast. Then we've written out the instructions. And all of these trades, today's a more intensive trade because we had to close our hedge for a profit, and we also entered a new hedge. But normally these trades take about 2 minutes. We're going to buy back, we're going to buy to close the last trade, as you can see right here, and then sell to open and drop the expiration. Now this was an abnormal trade because normally we don't trade on Tuesdays or Thursdays. We're only going to be doing that if there's a real threat to the market, a real fundamental change in the way the market's positioned. And usually it doesn't pay off to do the emergency alerts. As you see, we would have made an extra about $8,000 today had we just held on to the risk and counted on the rebound today, as we've seen all week. But again, I would rather play it safe, have a position where we're wrong. We're going to get $40 per contract, which is what's happening right now, although there's still some time left today and tomorrow. And if we're right, we're going to make even more. Would you recommend minimizing overnight portfolio risk using futures contracts? No, I would not have more protection than so let's look at how much risk I've put into our portfolio relative to the total portfolio size. So what is the worst thing that could happen to me between now and Friday? Sure, we all like to generate profits, but we're really in the game of mitigating risk. So think of yourself as a bank. Your main problem is just mitigating big risks. So in this setup right now today, let's just look at the delta of the strike we wrote. And the delta sure is not 100% accurate as what the probability is, but that's the probability the option market is giving these strikes. So gotta go 25. Okay, so the delta of today's trade, let me just double check the strike we put in there. 275, wow. Okay, well, I'll even go up to the one that you could follow right now. The probability of the SPY hitting 277 between now and tomorrow morning, or really tomorrow's close, is 94% not going to happen. So from a purely theoretical probability analysis of the delta, This trade has a 94% win rate at the 277 strike. Now let's see where mine is from earlier today. 97%. Okay, that's a good probability. So show me a trading strategy that will protect your capital, have a 90% probability of winning, and generate a profit if you're wrong. There's nothing else out there. So we're pretty much set to jet protection wise just from our covered call. We really don't need extra hedges to protect the SPY when we have covered call that's deep in the money. Now, where are we getting a little bit greedy? That's this trade. This is our greedy high risk trade. It's all you need to add a lot of extra protection and profit from a surprise. So most likely this trade will lose a little bit. We'll close it out next week once we see there's some real progress in the trade talks. Or let's say Trump blasts out some fury and fire over the weekend. This one's going to pay off huge. So let me pull up the option chain on this one. And it's losing value quickly, which is fine. So the covered call generating a profit if we get assigned overnight, no problem. And it offsets some of the loss on this. But let's look at this option chain. Now, typically when I do a long option, first of all, there has to be a real fundamental reason that I'm worried about the market. I'm not going to do it just because there's a sell-off. There has to be a real threat. And so we do have a real threat. We have a threat of tariffs slowing down global economies. And that could cause a real panic in the stock market. So this is the sniper shot that can generate a huge profit in that sort of scenario. Now, we did one contract per 100 shares of the SPY, so that's a 1% risk. Even if this put option went to zero, and we would not hold on to it till it went to zero, we could only lose 1% total portfolio. So I'm very, very, very hesitant to risk money betting down when we can get a risk-free way to do that with covered call. And the more the volatility gets, the better the deal becomes for us, because we can go deeper, deeper, deeper in the money and still generate a profit when we're wrong. So we went with the 264 strike. And I will include tomorrow the analysis of a very famous bank now that is become very famous for being able to predict if the SPY hits certain price levels, that will cause automated selling with different CTA funds. So it's been, to a degree, very accurate, except for when the Fed has come out and lowered rates, or it's talked about not raising rates, which has overridden some of their predictions. So right now, this is trading at 290. We came into it at 360. So it's sitting on a small loss, but that can quickly change. And so if the SPY were to drop $20 in a very short period, this would most likely be trading up here in the $6 range. And then after it goes below that, that's when it could really, really rapidly. So if we were to go $10 below the 264 mark, we might be able to sell this for around 12 bucks. And with the volatility increasing, it'd probably be closer to 15. So just 1% of our portfolio could deliver around 3 to 5% total return on the portfolio in the next month. And that's if trade war really escalates. I don't think that's going to happen, but if it does, this is a nice risk reward. We're looking at a potential 3 to 5% total gain on the portfolio. And if things don't escalate, we will close it next week and probably lose around 0.2 to 0.3%. So it's a great risk reward ratio, but it's a long shot. It's a sniper shot, and it's really betting that things escalate. So that's how we have a little extra ammo to profit from a downturn. and it replaces our ETF hedges. Now the ETF hedges are great for a nice long slow pullback and easy to manage, but it's not going to get you those 300, 500, even 1,000% returns that we can get by just buying a put option. So rarely will I do that, and only after the market is showing two things. One, it has to show me weakness, which we got. And then two, we need a fundamental threat to the market that's going to actually just reverb in the news and create fear in the market. And so we have that situation. We have a good reason for fear in the market, and we have seen a pullback. So I bought one put per 100 shares in this model portfolio. That's 17. Okay, Mark Sarvis says, instead of spending 28K on the SPY, why not sell a credit spread with the 277, 265? Yeah, well, sure. I have had products, Mike, that do spreads, and the risk reward on those sort of trades are much different. So in our product, if we lose more than 1% in a week, it's a huge deal. Okay. We're able to put 100% of our capital to work and protect it and generate a nice slow return over time. And if you think about it, if I can pull $25 out of the market, selling a call option, enjoy the underlying asset appreciate and average around a 12% return per year just from the covered calls, that's a nice strategy. If I start writing spreads, typically I'm in a situation where I might make a 80% return, but I'm setting myself up for a 20% loss. So you're going to be very scared to put your capital to work doing spreads, because you're going to know if you're wrong, you stand to lose at least 20%. And sometimes much more. If you start doing iron condors, it's even worse. Now you're trying to pull, maybe a 40% return, but you could lose 60%. So you end up trading small amounts of capital, and really it's just a joke. The option market is designed to do two things. Number one, most importantly, the option market is to protect assets for the rich. Number two, it's designed to take money from stock speculators who want to do what I would say risky trades like spreads. So that's why we don't do that. With this strategy, I can be confident to put 100% of my capital to work. I can protect it, and I can pull a consistent profit regardless of market direction. Now, if market's going up, it's gravy for everybody. And I think we are in a situation where we get through this trade war that the market can break into new highs. And that's where we write the out of the money covered call. We watch our SPY go up in value, and we watch the speculators see that, well, actually the SPY is not going to go up $3 to $4 every 48 hours. So they lose the option premium. We make profit with a double whammy. The underlying asset goes up, plus we're pulling out their extreme bullish bets out of the option market. In a downturn, we can just flip it the opposite. We can sell that in the money covered call, protect our assets, and generate a profit even when we're wrong. So to really reiterate, if you start doing any kind of option trading strategy, no matter what it is, you're setting yourself up for huge losses. And the reason that people like that is because they go for big gains. So while you're looking at 10, 20, 50, 100% return with various spread strategies, you're also setting yourself up typically for equal losses. And so you learn the hard way that you can't bet a lot of money using spreads. So sure, you could follow the trend, get a huge hit, feel good, and then you give it back the next day when the market's not going your direction. So that's not what we're trying to do here. We're trying to be the bank, own the important asset. We know the SPY is the single highest traded security in the world. It averages $16 billion a day. GDP is at 3.2. Profits from all the corporations are beating expectations. The bond market is pathetically low, so there's no competition to buy bonds. In fact, most people buying bonds I mean, look at it. If you're making 2.5 on the Treasury, less than that. If the Fed's telling you they're going to force inflation to 2% and run it higher, which means the value of your dollar is going to lose 2% a year, why on earth would you lock yourself into a 10-year Treasury that's going to make you 0.5% a year? It makes no sense. So people are simply trying to flip their bonds for a big profit. They think that's going to go even lower. And so I don't think it will. So watch, when that yield starts to hike, all these people realize their bonds are losing value. They don't want to hang on to it for 10 years and probably break even if inflation does perk up. They're all going to rush out of that trade and jump into the SPY. So yeah, that's why we do it the way we do it. And if you go over to Europe or Germany, I think it's negative 50 basis points in the German bonds, and in the Hong Kong market, which is the proxy for China, I think it's at 1.7. So there's just no reason to put your money anywhere else other than the SPY. So that's why we want to own the SPY. It's the best asset in the world. It gives us exposure to the top 500 corporations, and it allows us to put ourselves in a very high probability trade when we need to. So when there is a fundamental risk to the market, all we have to do is write the in the money covered call. We're protected. Now show me a strategy that gives you 90% probabilities in times of danger with very little risk of losing if you're wrong. You can't do it without doing this exact strategy. And so yeah, there's no magic to this. This is very simple, very repetitive. My job is to primarily look out for big risks and tell us when it's to play it safe. And so gradually, as the week has progressed, we've become a little more safe, and we'll probably reverse course next week back to being a little more neutral unless things escalate. So we're playing it safe today through tomorrow, most likely tomorrow through Monday, and then we'll see what the market's doing by then. Now, meanwhile, sure, is the SPY great? Is there a better way to do it? Yes. So if we look at where the SPY flows our capital for us, this is a concentrated version of the SPY where we take out all the little guys. Now we're living in a world where the winner continues to gobble up all the little guys. I think Apple is buying out a company every week. So trying to pick out the hot winners in the S&P 500. I mean, look, 8 companies represent the bulk of that SPY. So the other 492 are tiny. They're just tiny little gambles out there where most of the money is flowing straight to these big dogs. So that's why this portfolio has a lot of advantages. Number one, it has guaranteed capital flow from the SPY ETF, the QQQ ETF, and all other index ETFs. There's a lot of competition out there now. That's number one. Number two, now we can write the covered call at different strikes per security. Option market is relatively accurate at predicting which stocks are going to go up, flat, or down. And it's as simple as looking at where the open interest and volume is sitting when we write the covered calls each Tuesday. And when we're worried, we ignore what Wall Street's betting and we just write the in the money covered call. So that's what we did in this program. Because it does not have the luxury of adjusting the positions so quickly like our basic program does, we wrote these very defensively, not just last week, but also this week. And despite being defensive in a bull market, we've had a huge return. Now it's not at 21%. When we cover these on Tuesday, we'll see what our true return is. It was around 12%, so about twice the return as our basic program. And that's because these individual securities have more volatility historically than the SPY, which makes sense. So the more volatility, the higher the option premium. And so even though these companies are gobbling up all the competitors, they're expanding into their competition's marketplace, they're buying out the competition, and assimilating them into their own stock. They have the most profit, the best credit ratings, so they are buying back their own shares with the profits they're earning. So you can see why these continue to just greatly outperform the market. And if you have 150,000 or even just 75,000, you can use one-to-one margin. You can build this exact portfolio. You can reduce your work to one trade a week. Now, for those of you on a free trial, you get 30 days access to our Diamond program when you upgrade. And so that way in 30 days, you can decide, do I want to just do the SPY program, more security, more frequent trading, more protection because of how nimble we are and how frequently we're trading it, or would I rather go for a higher return and a more passive strategy? So that's a decision that will make sense based on your unique situation. All right, guys, any other questions out there? Okay, you have 8 stocks in the Diamond, but you put no more than 5% in any one stock. That's not true. So right here's the portfolio percentage allocation. And so here's what's really neat. The way the software is designed is color-coded. Steady income goes to Microsoft. Microsoft is the most important company in America. It has an extreme monopoly on the Windows platform. It's expanding into all sorts of markets. It continues to have better growth than all the other tech companies. If you look at its chart, the thing just goes straight up. In downturns, it has less downturn than its peers, and in up moves, it just rockets higher. The problem with Microsoft is that because of its small volatility, it offers the same option premium as a SPY. So it's kind of crazy that a single security has the same volatility and option premium as an entire S&P 500 index. This is the largest position in the SPY, and of course, I think it's the most valuable company right now. Of course, it's been going back and forth with Apple and Amazon. So this represents 20% of our portfolio, and it's very similar return in terms of the covered call as a SPY. Now, if you didn't want that position, you could just zero that out and flow that capital right here to the higher risk, higher covered call premium. And you can see how this will automatically adjust our target percentages. Now we would have a 0% target in Microsoft and be heavier in Apple. Now I don't recommend trying to outthink Wall Street. This whole product revolves around looking at what Wall Street does and just pulling out the easy money off the option markets. We know where Wall Street's putting all their cash. They're putting it into the SPY ETF, and that's flowing right to these companies. So that's how we chose this portfolio. The relative size, or how much capital we invest relative to our total portfolio size, is in ratio with the SPY. Now, if we look at Berkshire, that's a huge position in the SPY. Half of their capital owns the Apple, Bank of America, Wells Fargo. So this is really just a rip-off of the SPY ETF built by hand. And so that's why it's doing so well. Okay, Mike came in with a question. Okay, let me read out loud his question. Okay, in simple terms, you're selling a call wanting the SPY to remain above the strike price of $275. If it does, you collect the $9 premium, simultaneously buy a put to protect if the small SPY falls below $275. Kind of. So let's look at our dates. So the dates make a little bit of a distinguish. So the covered call we wrote today is expiring tomorrow. And it had a $40 baked into the cake profit. If we're wrong, the market goes up. If the market goes flat or sideways, the value of that call option is going to depreciate. So we'll be able to buy back that call option tomorrow for a profit. And most of that profit is going to be in the volatility decreasing, which is going to make the call option lose value from the two reasons. The volatility decreases, and so then also the time premium is eroding. So most of the profit we make from our covered call is going to be from the option premium losing value over time. And that's how we're making a very consistent return while being able to protect our assets. So between now and tomorrow, we have a trade that, according to the Delta, has about a 98%, or rather 97% probability of not happening. So the only way we would lose money between now and tomorrow is if the SPY dropped below 275 just from this. So that's very, very highly unlikely. Now this trade is one that I will rarely put on. I hate to buy long options. This is a rare case where we are buying a long option. For every 100 shares of the SPY we own, because there is two things happening in the market. Number one, the market has already begun to show weakness. That's step one before we'll buy this kind of a hedge. Step two, we need to have a fundamental reason the market's scared. And we have that. Trump is going to raise tariffs at midnight tonight. Okay, so that's the only reason I would put on such a leveraged position. Now this one expires July 19th. Now realistically, that's only giving us protection until about June 19th, because we need to sell it before we get within a month of expiration, and that's when that time premium is going to be eating us alive. The strike price on this is based on some CTA analysis. If we hit the 264, that could potentially create a huge selling wave. So we want to own the put option right at 264, so that if it goes below it, these profits go up incrementally. So my expectation, if we do get to that level, is to sell this for around $10 to $15. Now, on the other side of the coin, if we're wrong, what happens if we're wrong? Well, come Monday or Tuesday, we'll sell this for a loss. We'll have made some money on our in-the-money covered call to help offset that loss. And then we'll be back to business as normal. We'll be writing the covered call, but with elevated option premium. As long as the VIX is trading up at these levels, our option premium is about 4 times higher than it was all year. So the marketing we do for this product is trying to get around a 1% return per month without missing out on the upside of the SPY. And so far we've averaged around 2%. So we're over delivering. When the market goes up, it's easy. Everybody does well. But what happens when the market goes flat or down? So that's where our product really can shine. Everybody else is probably freaking out right now. We're in a situation where you can sleep well tonight. You know that there's a 98% probability we're not going to get below 275 between now and tomorrow morning. And even if we do, we have a hedge that will go up exponentially with our long put. So very rarely will we put on this trade. Earlier this week, Mike, on Monday, we had put 5% hedge into these ETFs, which are inverse ETFs. We sold them for a profit today. Not a huge profit, but a decent profit. So we came into FAS at 803, sold it for 864, came into TEX for 1322, sold it for 1484. So if we think there's just a slow, gradual pullback, the inverse ETFs are great. If we think there's a real threat that could create a real market panic, that's the only time we will jump into a long call option. So or rather a long put option. And so I'll buy long put options for a premium when the market has already shown weakness and there's a big threat looming over us. So this is a rare situation where we have both of those. Otherwise, we prefer to do these rather risk-free methods of protecting for downside and generating that boring return. And yeah, I mean, if you look at it, to pull off just a 10% return, we would need the SPY to trade to 330 by the end of this year. Okay, so you could buy and hold some stocks and pray that they go up, or you could do our strategy, protect your capital, pull about 25 bucks 3 times a week out of the option market, and potentially get both. If market goes higher, great. Our SPY will appreciate, and we're going to be selling those far out of the money covered calls that typically do not generate a profit for the call option buyer. Market goes flat or sideways, we'll be reacting accordingly with these in the money covered calls. So as long as this VIX is up at a high level, the business of selling call options is extremely lucrative. Now, we don't want to give up cash to brokers for free, especially when we have a strategy that's taking advantage of basically the out of the money option market. So it does make sense to either use Robinhood, which has a great phone app, makes this strategy super easy. Can do it on the go, takes less than 2 minutes, Monday, Wednesday, Friday. Rarely we'll send you an emergency alert like we did today. And that's only when there's a lot of reasons to say, hey, let's play it safe. They don't do 401ks. They don't have a support line. So this is good for folks who can do a covered call and want to pay nothing. These guys are the fastest growing brokerage in the world. They have private equity in San Fran. They're valued at $5 billion. They pay for every last little part of this strategy, but it is only cash accounts. They'll give you one-to-one leverage at a interest rate of 5% a year. So if you only had 15,000 or 75,000, you could still follow our 2 products and do this strategy fine. Interactive Brokers, great broker, been around a very long time, one of the largest. They have very low rates, very good for our strategy. Trader is a smaller gig. I knew their CEO for a while. That's who's powering all the charts and prices that are in my screenshots. They got a little blown out by Robinhood. They have very good rates, but they couldn't compete with completely free. So they do accept 401ks. They have very good rates as well. Probably Interactive Brokers would be your best bet for a 401k. How is Robinhood making money, just for curiosity? Sure, so they actually sell the trading volume. Hedge funds will pay the broker to have the first right to fill your orders because they think that you're going to make a stupid trading decision and they can take advantage of that. So that's how they do it. Now, they're desperate to get large account sizes. They've been attracting the millennials with 300 bucks. And so that typically is very foolish folks who go into look for risky trades. So it makes sense. On our side, as you can see, we have the odds on our side. Now that doesn't mean a huge, like James Simon averaging 30% a year, completely artificial intelligence trading. They can take our trades, manipulate 5 trades around it, and be in a situation where, we're trying to pull 25 bucks out of the market with 30 grand 3 times a week. They might be trying to pull like 30 cents off of $30,000 and try to do it every 5 minutes with very low risk. So that's how they make money. Now, they're really not trying to get rich from that. They're trying to get rich from private equity. They want to get the biggest user base and take down some of these giant broker dealers. So that's their game. And it's like the Netflix model, taking tons of private equity, give it all away for free, and worry about making money 10 years from now. That's kind of their game plan, which is great for us. I mean, absolutely great. Now, do you get a worse fill from Robinhood? No. All of this money flows into the same liquidity pools, no matter what broker you're at. So we're gonna get the same rates as everybody else, just for free. So it definitely makes sense to go to Robinhood for cash, and probably Interactive Brokers for a 401k. Any other questions out there? All right, guys. Well, I appreciate everyone's time today. We have the same schedule to close out the week and next week, Monday, Wednesday, Friday, noon Eastern. You'll get an email and text message with the trade alert. Tuesday, Thursday, live webinar with Q&A. And if there are any sort of emergency alerts, that'll come out at noon, Tuesday, Thursday. So really all you got to do is be willing to look for an alert at noon, Monday through Friday. 99% of the time, there's nothing that will happen on a Tuesday, Thursday, only when we have something extreme like we do right now. So thanks again for everyone's time. Looking forward to a new trade alert tomorrow, and we'll see where the market takes us overnight. Exciting times.